Quick note, this video is sponsored by me, and I want to give you a clarification. The programs linked down below, there is a coupon code expiring May 5th for those programs, but I have suggested that there's a possibility of me running for governor, and I just want to make it very, very clear, I have zero intentions of stopping making YouTube videos. Nothing is going to stop me from making YouTube videos. I will not be governor if I cannot make YouTube videos, so you are not going to see less of Kevin. You are not going to see me give up my side hustle and add lectures. I don't care if I have to get my lectures from my amazing programs linked down below approved before I post them. I'm going to keep my side hustle going no matter what happens, whether I win or lose, it doesn't matter. I will never forsake the people who have invested in my products. Always know that. Always know that I will put my money where my mouth is, and my word is as good as gold. Thank you so much for watching. Consider checking out those programs linked down below. Take advantage of that coupon code and know that Kevin will always be on your side. All right, folks, let's get started with the video. Hey everyone, me Kevin here. Let's have a conversation about this week coming up and some major market-moving catalysts coming shortly after this week as well. As always, though, remember that we are on a long-term rocket ship. There we go. To the moon. All right, folks, let me first touch on a little bit of the madness that's going on, and then let's hit those catalysts. So let's keep this quick and simple. First, we know that hedge funds and institutions have massively leveraged up their short positions in Q1 to protect against Q1 earnings misses. Earnings expectations at big tech companies were very, very high. Short positions to hedge long positions were very high, which led to downside pressure for a lot of these stocks and explains why companies like Amazon and Apple could absolutely smash and destroy earnings, yet still end up seeing red. It's kind of weird. But it has also led to a disproportionate sell-off in tech and in SPACs and in consumer discretionaries as institutions balance or try to protect or hedge themselves against potentially higher prices in consumer discretionary and tech or SPACs by rotating into other sectors, whether they're industrials or whatnot. They're moving over. So that's why we're still seeing the S&P 500 or indices moving up, while certain segments, which are very popular, especially here on YouTube, tech, consumer discretionary, and so on, our favorite companies, why those feel like they're selling off, yet index funds feel like they're doing so well. It's that rotation into other portions. So you see this up while you see a little bit of a down. This is why the indices keep moving while some of our favorites are suffering. But this is normal, and this is very important to know, is hedge funds do this. They cover themselves for the possibility of bad news coming out of earnings. But we actually had generally pretty good news coming out of earnings. Most companies are expecting either growth or maintaining the levels of growth that they've already had. Most companies beat earnings that have reported thus far. And so, sure, in the short term, it's going to look like the Weenie Baby shorts and the suits are winning again as they kind of beat us up with their short positions. This is true. They're winning in the short term. But in the long run, the favorite stocks that we're investing in my opinion, are primed for some big moves once we hit some special catalysts. So let's talk specifically about those catalysts. And so the first catalyst has to do with the end of peak growth rates, or as some people say, peak growth to shorten it. So here's the thing. Over the last year compared to now, so year over year data, a lot of companies' data looks like it's vertical. Like we're seeing straight up growth at many different companies. This is phenomenal. But investors, especially institutions, are protecting themselves because they're concerned that we can't sustain this kind of peak growth rate. And they're right. We can't. So what's going to happen is those rates of growth, those crazy, 30% year-on-year gains at Apple or whatever, these are going to slow down again and flatten. But they're going to flatten to levels that are way higher than we've seen before. However, that transition from taking that growth curve and flattening it is going to be a bit painful. And that's the pain that in part we've seen in conjunction with fears of higher inflation. That's the pain that we've seen over the last 2 months, and it's very likely going to continue until at least, in my opinion, Q2 earnings come out. So quarter two, remember, is April, May, June. That means come July, we're going to expect to see more normalized earnings. Okay, maybe Apple didn't grow 30%. Maybe it grew 3 to 6% quarter over quarter. which is still great. And all of a sudden, we start seeing shorts and people protecting themselves, hedging against potentially very high expectations, start rotating back into companies that they've sold off because all of a sudden, hey, all right, we got over that rotation from having massive growth to having normal growth again. Now it's time to play ball again and get back into these companies. Now, this is leading a lot of folks to say, hey, well, then let's just be out of the market until that happens. But be careful, if you miss the big rally days, you tend to miss out on some of the big and largest returns that the market can often yield. So this is why oftentimes buy and hold is such a beautiful opportunity. But what are some dates related to some of these expectations? All right, so let's put these on the calendar. In July, I expect to see a rotation back into many of the companies, or at least this rotation to begin. And this will continue between July and October. I'd expect between July and October, we start seeing shorts dissolve or sort of buy back their positions, close their short positions, and we get back into that long run trend of economic growth and company growth and investing growth in the United States. July to October, big catalyst period for shorts unwinding. It's also a big catalyst period for inflation numbers coming in, because here's why. Write this chart down or screenshot this chart right now. These are big dates right here. We are going to have right here on May 12th at 8:30 a.m., we're going to have a big CPI data release. This is expected to be the worst one. April is expected to be literally the absolute worst CPI data month for year-over-year data. But we're not just going to be looking for year-over-year data, we're going to be looking for month-to-month data. So you want to write down May 12th. So far, we've got to pay attention to July earnings. July earnings and people ending their shorts. Closing shorts. I'll just put closing S. Then we got to pay attention to May 12th. But we also have a catalyst this week. We have to pay attention to May 7th. May 7th is when we get a new unemployment data reading. There are fears that if the unemployment rate ironically falls too fast, inflation could stay higher because of a potential labor shortage. So we've got lots of catalysts. Then we have June 10th. This is expected to be the second worst CPI data month. So write down June 10th because that's when we get the May numbers. When we really expect to start seeing potentially inflation plummet, okay, this is where we're going to start getting to those green catalysts. Take a look at this. We're going to highlight July 13th, which guess what also happens around July 13th, folks? That's when we start getting earnings for Q2. Because remember, Q2, April, May, June. July is when we expect to see earnings for Q2. So if all of a sudden we get inflation falling and we get shorts closing their short positions because they realize they're shorting companies that are going to keep growing, even though they'll be growing at a slower rate, they'll still be growing. The high expectations of Q1 will have come and gone. We'll have more normalized expectations at companies like Enphase, Etsy, Apple, Amazon, Microsoft, Tesla, you name it. And we might actually start really surprising Wall Street to the upside again, both with inflation data, but also Q2 earnings data. This is why July is going to be the start of when we really want to potentially pay attention to a turnaround. Now, what'll be fascinating is by then we'll also get 2 more unemployment readings, which could potentially lead the market to try to start pricing in some positivity in July. But quite frankly, for me, my expectation is rally mode is somewhere in this region right here, somewhere between July and October. Now, I don't have a crystal ball, but as somebody who's very interested in knowing what's going on in the market, keeping my finger on the pulse of the market, I'm not your investment advisor. I'm not even an investment advisor. But as somebody who's looking at what's going on in the world, these are going to be times where I'm really going to be looking for all of these positive catalysts coming together. Think about what we've talked about, the unwinding of shorts, CPI data. And I know many of us don't believe in CPI data for inflation, but it's still a catalyst. Unemployment data, we're going to have more guidance. But guess what else we're going to have between July and October? Folks, right now, there is nothing but FUD around what? Supply. There is a massive supply shortage FUD right now. In fact, if you even just search supply shortages automakers right now, you will literally see article after article going, supply shortage gets worse and worse and worse and worse, worse than expected. It's all poopy-doopy right now here in May. Well, when is that going to start loosening? When is capitalism and manufacturing going to start catching up to where the supply shortages end? They're not going to last forever. They will last, but not forever. Well, my expectation is also the supply shortages will start to shrink. Guess what? Between July and October. Folks, we have a potential for serious downside over the next 2 months, May and June, while we continue to have this volatility. But I'm not selling because at some point over these next 2 months, we're going to start pricing in the potential for massive upside in this market. I could be wrong. So obviously, I'm just putting conclusions together, and I do not have a crystal ball. I could be wrong. But I want you to know I've got big options riding on my expectations for this green box happening. Now, most of my options do not expire until January 2023 and March of 2023. So even if I'm wrong about this green box, I'm still protected because this could come November, December. Maybe it'll come January to March of 2022. But this green box is coming. And when we see this quadfecta of supply problems going down, so supply problems, we put supply problems going down, CPI and actual inflation going down, shorts going down, and solid news on the unemployment front, but maybe not too good of news, but still solid news on the unemployment front, which remember the next data catalyst is this Friday. I'll be live streaming it when the numbers come out. When we get good news here, so I'll put a little plus for positive. When all of these four converge, as well as great results for Q2, Q3 at companies, folks, this is a recipe for an absolute boom. Now, no guarantees. And I believe we're going to have substantial volatility between now and then. But this right here, I am very, very enthusiastic about. Let me know what you think about my catalyst. Let me know what you think I'm missing in the comments down below. By the way, if you like my perspective, consider checking out programs, a link down below. Use that coupon code that is expiring May 5th. That's really soon, folks. That's in 3 days. We'll be changing the pricing to the upside for the amazing programs on building your wealth and private live streams with me. Check out those programs, link down below. And folks, we'll see you again soon.